Here's another example of taxes. So two things in life are for certain, death and taxes. Death can make one sad. So let's be happy and talk about taxes, because taxes make one happy, maybe. So we want to know what happens when government imposes a tax on producers. Meaning that for every good that the producer produces, they're going to have to pay a tax on that. So we have our original equilibrium, price and quantity, where everything is good. And now we're going to distort that by imposing a tax. So here on the side is, in a sense, a 5-step process we can follow to identify what happens. Step 1 is identify if this is a supply or demand issue. Well, because it's on producers, the supply curve is represented by the cost to producers to produce. So this will be a supply issue. So we're going to use our ruler to cause our supply curve to shift up by the size of the tax. So there is our new supply curve. Okay, so we've done step 2. Step 3 is find where the new curve meets the old curve. So here's our new curve that intersects with the old supply curve, or the old demand curve, sorry. We then bring this amount down, and this is our new quantity with taxes. So now we have found this value here. Step 4 is we take that value, we put it into the supply equation, bring that across. That's the price that the seller receives. We take that Q for step 5 and put it into our original demand equation. That's the price that the buyer pays. So here what we see is that a government imposes a tax. The quantity goes down. We take that quantity, put it into the supply equation that tells us the price of the seller. Take that quantity, put it into the original demand equation. It tells us the price of the buyer. And there we found the 3 important parts. And again, to identify this distance here is the size of the tax.